You have 90 days. That's not dramatic exaggeration. That's not fear-mongering. That's mathematical fact based on what happened in Rome, Argentina, and 2008. But here's the thing. You probably don't realize you're in those 90 days right now. Because the signals are subtle at first. They don't hit you like a headline. They appear in places most people aren't looking. In credit spreads that move by 0.5%. In yield curves that invert in ways the media doesn't explain. In Fed statements that use language slightly different from usual. In bank stock prices that dip for no reason. By the time the signal becomes obvious enough for the mainstream media to cover it, you're already past the initial warning phase. You're already in the cascade phase, already in the part where things move very fast. In the previous video, we talked about 2026 as the year when the mathematical tipping point arrives. But here's what most people don't understand. The tipping point doesn't happen on January 1st, 2026. It doesn't happen on a specific date. It happens in a window of 90 days where conditions become critical. And that window doesn't necessarily start in 2026. It can start in late 2025. It can start in early 2026. The window is defined by the signals, not by the calendar. Right now, at this moment in late 2025, we need to understand what those signals are. Because if you're watching this video and thinking, okay, I have until 2026, you might be wrong. You might only have weeks. Let me be very specific about what we're looking for. There are 5 signals, 5 measurable, observable indicators that tell you we've entered the 90-day window. Not 5 vague feelings or hunches. 5 concrete things you can track. 5 things that appeared before Rome collapsed. 5 things that appeared before Argentina collapsed. 5 things that appeared before Lehman collapsed. When you see 3 of these signals happening at the same time, you're in the window. You need to act. When you see 4 or all 5, you don't have time to think. You need to have already acted. Let me walk you through each one. Signal number 1. Credit spreads widen unexpectedly. The first signal is credit spreads. Now, if you don't know what that is, don't worry. I'm going to explain it in simple terms because this is the most reliable signal. A credit spread is the difference in interest rate between 2 types of debt. Specifically, it's usually the difference between what the government pays on bonds and what corporations pay on bonds. When the economy is healthy and people have confidence in the system, the difference is small. Maybe the government pays 3% on a 10-year bond and a corporation pays 3.5%. The spread is 0.5%. Pretty small. But when people start to get nervous, when they start to realize that corporations might be at risk, they demand higher interest rates from corporations. They want more compensation for the added risk. So the government still pays 3%, but now corporations have to pay 5% or 6%. Suddenly the spread is 3%. That's a massive change. And here's the key. Credit spreads widen fast. They don't widen gradually. One day the spread is normal. The next day, sometimes literally overnight, the market reprices everything. In Argentina, credit spreads started widening in February 2001. By March, they had blown out dramatically. By April, the government couldn't borrow money at any price. By December, the crisis was full-blown. In 2008, credit spreads were normal in June 2007. By August 2007, they were blowing out. By September, the system was seizing up. Right now, we need to watch credit spreads. If you see them widen by more than 50 basis points, that's 0.5%. In a week, that's a signal. If they widen by a full percent in a month, that's a strong signal. You can watch this on Bloomberg Terminal if you have access. Or you can watch it on financial news websites. Any serious financial news source will report when credit spreads widen significantly. When they do, that's signal number 1. Signal number 2. Bank stock prices decline 10–15% without obvious cause. The second signal is bank stocks. And I don't mean a small decline. I mean a significant move. Banks are the nervous system of the financial system. When banks get scared, when banks sense that something is wrong, they stop lending. And when banks stop lending, everything stops. Bank CEOs are very smart about reading signals. They have access to information about credit quality. They understand counterparty risk. They know things before the general public knows. When bank stocks start to decline without an obvious cause, it's often because banks are starting to price in a problem they see coming. It's like watching dogs. Dogs know when an earthquake is coming before humans do. They sense something in the ground that we can't feel. In Argentina, bank stocks started declining in August 2001. The reason given by analysts was vague. Concerns about the economy. Worry about the government's fiscal situation. Nothing specific, but the banks knew something was wrong. In 2008, bank stocks started declining in July 2007. Analysts were confused. Why are bank stocks going down? The housing market looks fine. But the banks knew. They were looking at their mortgage portfolios and realizing the numbers didn't add up. Right now, we need to watch bank stocks. Specifically, watch the major U.S. banks. J.P. Morgan, Bank of America, Wells Fargo, Goldman Sachs. If you see them collectively decline more than 10 to 15% in a month without a specific external event, that's signal number 2. Not a market-wide decline. I mean specifically bank stocks declining while other stocks hold up. That's when you know banks are pricing in bank risk. Signal number 3, government bond yields. Spike suddenly. The third signal is government bond yields, specifically 10-year Treasury yields. When people have confidence in the government, they're willing to buy government bonds at low yields. They think the government is safe. But when people start to lose confidence, they demand higher yields to compensate for the increased risk. Now, the Federal Reserve can suppress yields artificially by buying bonds. By flooding the market with money, they can keep yields down artificially. But there's a limit to how much they can do this, because if they keep printing money and buying bonds, inflation accelerates, and then they have to stop. And when they stop, when they can't buy anymore without hyperinflation consequences, the market reprices bonds. Yields spike. In Argentina, 10-year equivalent yields spiked from 4% to 8% in a matter of months. Then they kept going higher. In 2008, there was a brief spike in yields as the crisis unfolded, but the Fed intervened quickly, so it was shorter than Argentina. Right now, we're watching U.S. 10-year Treasury yields. The current level is around 4.5% as of late 2025. If you see those yields spike above 5.5% without the Fed being able to push them back down, that's a signal. If they spike above 6.5%, that's a strong signal. The key word is without the Fed being able to push them back down, because the Fed can intervene temporarily. But if the market is panicking hard enough, the Fed's interventions will only slow the spike, not stop it. Signal number 4, capital flight. Foreign investors selling dollars. The fourth signal is capital flight, and this is very observable in real time. When foreigners start to lose confidence in the US dollar, they start selling dollars and moving money out of the US. You can see this in the dollar index, which measures the value of the dollar relative to other currencies. When capital is flowing into the US, the dollar is strong. When capital is flowing out, the dollar weakens. Now, the dollar can weaken for many reasons. Interest rate differentials, trade flows, all kinds of things. But when you see the dollar weakening rapidly without those fundamental reasons being present, that's often capital flight. In Argentina, you could see capital flight very clearly. The peso, which was pegged to the dollar, was suddenly not. Capital was fleeing the country so fast that they couldn't maintain the peg. In 2008, there was capital flight into the dollar, not out of it, because the dollar was seen as the safe haven. But within the dollar system, you could see capital fleeing from risky assets into Treasury bonds. For America in 2025-2026, capital flight would show up as a rapidly weakening dollar. If you see the dollar index drop more than 5% in a month without obvious fundamental cause, that's signal number 4. Signal number 5. Credit card defaults and personal bankruptcies spike 15% plus, year over year. The fifth signal is real people, real defaults, real bankruptcies. By the time credit card defaults and personal bankruptcies are spiking, the problem is already in the system. It's not new, it's been building, but it's at the point where ordinary people can't hide from it anymore. In Argentina, personal defaults and bankruptcies started spiking in mid-2001. By the end of the year, they were off the charts. In 2008, personal bankruptcies started spiking in late 2007 and early 2008. By the time they spiked significantly, the housing crisis was already well underway. Right now, we need to watch credit card default rates and personal bankruptcy filings. The data comes out monthly from credit bureaus and the courts. If you see credit card defaults jump more than 15% year over year, and if personal bankruptcy filings jump significantly, that's signal number 5. The interesting thing about signal number 5 is that it lags the other signals. By the time you see signal 5, you've already seen signals 1 through 4. So signal 5 is confirmation that the crisis is real. So those are the 5 signals. Let me repeat them. Signal 1. Credit spreads widen by more than 50 basis points. Signal 2. Bank stocks decline more than 10 to 15%. Signal 3. Government bond yields spike above the Fed's preferred level. Signal 4. Dollar index weakens 5% plus in a month. Signal 5. Credit defaults and bankruptcies spike 15% year over year. Now here's the important part. You don't need to see all 5 signals for this to be real. 3 signals together happening in a cluster means you're in the window. 4 or 5 signals means the cascade has started. Okay, so now you know the 5 signals. But knowing them isn't enough. You need to know where to look. You need to know exactly what websites to check. You need to know what to type into Google to find this information in real time. Because this information is all public. It's not hidden, but most people don't know where to find it. Let me walk you through exactly how to track each signal so that when it starts to move, you'll see it immediately. How to track signal 1. Credit spreads. Credit spreads are published daily by multiple sources. The most common spread to watch is the HYOAS, which stands for High Yield Option Adjusted Spread. This is the spread between corporate bonds and U.S. Treasuries. Where to find it? Go to CNBC.com, search for HYOAS or credit spreads. Bloomberg.com also publishes this. Yahoo Finance publishes this under credit spreads data. What to look for? Right now, in late 2025, the HYOAS is probably around 400 to 500 basis points. That's normal for current conditions. If you see it jump to 600 basis points in a week, that's a move. If it goes above 750 basis points, that's a major move. That's signal 1. The chart will show you daily data. Set a calendar alert for yourself. Check it every Friday. If you see a sudden spike up, that's your signal. Why this matters. Credit spreads are the market's way of saying, we're nervous about corporations being able to repay debt. When spreads widen, it means the market thinks corporations are at risk. That's the canary in the coal mine. How to track signal 2. Bank stock prices. Bank stocks are easy to track because they trade on regular stock exchanges and the data is everywhere. Where to find it? Yahoo Finance, Google Finance, your brokerage app, CNBC, MarketWatch. Any financial news site will have stock prices. Which banks to watch? Focus on the big ones. JP Morgan Chase, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley. These are the systemic banks. If these go down together, it matters. What to look for? Watch these 5 banks for the past month. What's their average stock price? Now set a mental threshold. If any of these stocks drops more than 10% from that average in a single week, that's a yellow flag. If 3 or more of them drop that much together, that's signal 2. How to track this easily. Create a portfolio in Yahoo Finance or Google Finance. Add these 5 bank stocks to your portfolio. Check it once a week. Set an alert so you get notified if any of these stocks drop more than 10%. Why this matters. Bank stocks are the canary for banking system health. Banks are where the money flows. If banks are getting hit, it's because they're pricing in risk they see coming. How to track Signal 3. Government bond yields. Government bond yields are published constantly and are probably the easiest data to access. Where to find it? CNBC publishes the 10-year yield constantly. Search 10-year Treasury yield on Google or any financial website. You'll get a chart with historical data and the current yield. What to look for? The 10-year yield is the most important one. Right now, it's probably around 4.5% or so. If you see it spike above 5.5% in a week, that's unusual. If it goes above 6.5% and the Fed isn't able to push it back down, that's Signal 3. How to track this? Check it once a day. It updates during market hours. Create a simple chart on your phone or computer showing the past 3 months of 10-year yields. If you see a sharp spike up, that's your signal. The key indicator: is the Fed buying bonds to suppress yields, or are they letting yields rise? If yields are rising despite Fed intervention, that means the market panic is stronger than the Fed's ability to control it. That's when you know something serious is happening. Why this matters: government bond yields tell you what the market thinks about government creditworthiness. When yields spike, the market is saying, we're not confident the government will repay this debt, or at least, we need much higher compensation for the risk. How to track Signal 4. Dollar Index, DXY. The dollar index measures the value of the US dollar relative to a basket of foreign currencies. Where to find it? Search DXY Dollar Index on any financial website. TradingView has it, Yahoo Finance has it, CNBC has it, MarketWatch has it. It's everywhere. What to look for? The dollar index fluctuates, but right now, it's probably in the range of 103 to 106. If you see it drop below 100 in a month, that's significant. If it drops below 95, that's capital flight. How to track this? Check it once a week. Create a chart showing the past 6 months. If you see a sudden downward slope, that's your signal. The context matters. Is the dollar dropping because of Fed policy changes, or is it dropping because foreigners are fleeing? You can tell the difference by looking at other things happening at the same time. If the dollar is dropping but Treasury yields are rising, that's panic, that's capital flight. If the dollar is dropping and Treasury yields are falling, that's the Fed easing policy. That's different. Why this matters? Capital flight is when foreign money leaves the country. When it happens fast, it's a sign of panic. It means foreigners are losing confidence in the US financial system. How to track Signal 5. Credit card, defaults, and bankruptcies. This data is published less frequently than the others, but it's still publicly available. Where to find it? The Federal Reserve publishes delinquency rates and default rates for credit card debt. Search Federal Reserve credit card delinquency rates. The data usually comes out quarterly. Personal bankruptcy data comes from the U.S. courts. Search bankruptcy filings statistics. The data comes out quarterly or monthly, depending on the court. What to look for? Look at the year-over-year change. If credit card delinquencies jump 15% or more year-over-year, that's Signal 5. If personal bankruptcies are up significantly compared to the same quarter last year, that confirms it. How to track this? Set a calendar reminder for when this data is released. Check it when it comes out. Compare it to the same period last year. If you see a spike, that's your signal. The lag factor. Remember, this signal lags the others. By the time you see this signal clearly, you've already seen signals 1 through 4. So Signal 5 is confirmation that the crisis is already in motion. Why this matters? This is real people feeling real pain. When ordinary people can't pay their credit cards, when ordinary people are filing for bankruptcy, it means the crisis has reached the household level. It means it's affecting people's lives, not just financial markets. So now you know where to look and how to track each signal. But tracking isn't enough. You need to know what to do when you see them. The weekly checklist: what to monitor every week. I want you to do this exercise. Print out this checklist, or write it down, or create a spreadsheet. Every week for the next several months, check these 5 things. Document what you find. This is your personal early warning system. Every Friday, check. Credit spreads. HYOAS. Is it above normal? Has it moved more than 50 basis points this week? Bank stock prices. Are JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley down more than 10% from their average? Are they moving together downward? 10-year Treasury. Yield. What is it today? Is it above 5.5%? Is it rising steadily? Dollar index. What is it today? Is it below 100? Is it showing a downward trend? Credit card defaults and bankruptcies. When was the last data release? What did it show year over year? Document everything. Don't just look and forget. Write it down. Create a simple table. Date, signal 1, signal 2, signal 3, signal 4, signal 5. Put the current values in each column every week. Why? Because when you see a pattern emerging over weeks and months, it becomes obvious. You're not guessing. You're not relying on intuition. You're relying on data that you've been tracking. What happens when you see 3 signals together? If you notice 3 of the 5 signals moving simultaneously, for example, credit spreads widening, bank stocks falling, and Treasury yields spiking, that's when you need to take this seriously. That's not coincidence. That's the market pricing in crisis. At this point, you need to ask yourself some hard questions. What's in your savings account? Is it in a bank that's solvent? Is it in cash? Or is it invested in stocks and bonds? What's your emergency fund? Do you have one? Do you have assets outside the traditional financial system? Anything physical? Anything valuable that you can hold? I'm not saying you need to go full doomsday prepper. I'm saying you need to diversify your exposure so that if the financial system experiences a crisis, you're not completely dependent on that system. People who survived Argentina did so because they had some assets outside the banking system, some cash in their safe at home, some physical assets. Some had foreign bank accounts, though those got frozen too. People who survived 2008 did so because they had income sources that weren't dependent on the stock market. They had jobs, they had skills, they had real assets. What happens when you see 4 or 5 signals? If you see 4 or all 5 signals lighting up at the same time, you're past the warning phase. You're in the cascade phase. This is when things move very fast. At this point, you don't have time to make big decisions. You should have already made them. You should have already diversified your wealth. You should have already reduced your exposure to vulnerable assets. If you haven't, then the best you can do is not make things worse. Don't panic, sell everything at the worst possible time. Don't move all your money into cash right before cash becomes worth less. Don't make emotional decisions. Instead, focus on stability. Focus on income. Focus on assets that will hold value. Focus on relationships and skills that will matter in any environment. The people who panic in a crisis are the ones who end up making the worst decisions. The people who stay calm, who have thought things through in advance, are the ones who position themselves best. The timeline. Once signals appear. Here's what we know from history. Once the signals start appearing, once 3 or more are lighting up at the same time, the cascade typically accelerates over weeks to months. In Argentina, it took about 12 months from when people really started to worry until the freeze happened. But the last 3 months were chaos. The government was passing new restrictions almost weekly. In 2008, once Lehman failed, the crisis became visible and undeniable. Everything that happened after that point was cascade and panic. For a modern digital economy, we should expect things to move faster. Markets trade in milliseconds. Information spreads instantly. Panic, when it starts, spreads globally within hours. So the timeline is probably measured in weeks or months from when signals appear clearly until something breaks. Not years, not even 1 year, weeks or months. This is why knowing the signals matters. This is why tracking them matters. This is why a 90-day window matters. If you're paying attention, if you've done your homework, if you understand what to look for, You can see the signals when they start. You can see them in real time. You can act before the panic reaches mainstream consciousness. The people who don't track this, the people who don't understand the signals, they'll be shocked when it happens. They'll think it came out of nowhere. They'll think it was unexpected. But it won't be. It will have been visible in the data for weeks, in the credit spreads, in the bank stock prices, in the bond yields, in the dollar moves, in the bankruptcy statistics. All of it will have been there. All of it will have been predictable. The only question is, are you the type of person who pays attention to the data? Or are you the type of person who ignores the signals and then acts shocked when reality catches up? Now, the million-dollar question. What do you actually do with this information? Because knowing the signals matters. Tracking them matters. But if you don't act on what you learn, it's just entertainment. It's just interesting information that doesn't change your life. So let me be very practical. Let me talk about concrete things you can do right now. Things that reduce your risk without requiring you to make extreme decisions or abandon the modern financial system. First, understand this. You don't have to choose between stay completely in the system or become a full prepper living off-grid. There's a middle ground. And most people who survived crises survived because they were in that middle ground. Option 1, diversify your savings. The first and simplest option is to diversify your savings. Don't keep all your money in one place. Don't keep all your money in the same type of asset. Right now, if all your savings are in one bank account, you're exposed to bank risk. If that bank fails, your money could be trapped. The FDIC insures up to $250,000, so you're theoretically protected up to that amount. But theoretically is the operative word. In a systemic crisis, even FDIC insurance gets tested. Solution: spread your savings across multiple banks. If you have $100,000, don't keep it all at JP Morgan. Keep $50,000 at JP Morgan and $50,000 at another bank. Or break it into smaller amounts across 3 or 4 banks. This costs you nothing. It takes about 30 minutes of work, and it dramatically reduces your risk. Beyond that, consider what percentage of your savings should be in cash versus other assets. Cash is safe in a currency debasement sense. You have actual dollars, not promises of dollars, but cash loses value if there's inflation. A reasonable approach. 60% in cash across multiple banks. 20% in physical assets if possible. Real estate is the best, but even things like gold or silver can work. 20% in productive assets that generate income, stocks that pay dividends, bonds that pay interest, a business that generates revenue. This isn't a perfect protection, but it's better than being 100% dependent on the banking system or 100% dependent on stock market prices. Option 2, reduce debt aggressively. The second option is to reduce debt. All debt. High interest debt first, but ultimately all debt. In a crisis, debt becomes a weight. If you owe money and your income drops, you're in trouble. If you owe money and inflation spikes, the currency you're earning in becomes less valuable. But the debt you owe stays the same amount of currency. In Argentina, people who had borrowed money in pesos and were paid in pesos were okay when the peso collapsed. They repaid loans with less valuable money. But people who had borrowed in dollars while being paid in pesos were devastated. They owed more real value than they had. The point: get rid of debt. Pay off credit cards. Pay down loans. If you can, pay off your mortgage early. Not because you're afraid of missing monthly payments. That's probably fine. But because being debt-free removes a major vulnerability. This is hard. Debt is seductive because it lets you have things now instead of waiting. But the trade-off is vulnerability. And in a crisis, vulnerability is expensive. A reasonable approach. If you have consumer debt, credit cards, car loans, personal loans, make eliminating that your priority. Set a 2-year goal to be consumer debt-free. If you have a mortgage, do what you can to pay it down faster. Even if you just pay an extra $100 a month toward principal, that reduces the amount you owe and accelerates payoff. Option 3, build income stability. The third option is to build income stability, not just income, stable income. In a crisis, income volatility is dangerous. If you have income that depends on stock market performance, or real estate prices, or consumer spending, you're exposed. If the market tanks, your income tanks. But if you have income that's relatively stable, a job that's critical to society, a skill that's always in demand, something that generates revenue even in a crisis, you're more protected. In 2008, people who worked in essential services, utilities, healthcare, government, maintained employment. People who worked in finance or real estate or construction got hammered. In Argentina, people with skills, plumbers, electricians, mechanics, doctors, were able to earn money even in crisis. People whose jobs depended on the formal economy got hit harder. A reasonable approach: develop a skill that will be valuable in any environment. Something you can do even if the financial system is disrupted. Electrical work, plumbing, medical skills, teaching, mechanical skills. Even just being good with computers is valuable. Don't necessarily quit your current job, but develop a side skill, something that could generate income if you needed it to, something that people will pay for even if the economy is in crisis. Option 4, build relationships and community. The fourth option is less financial and more social. Build relationships with people, build community connections. In a crisis, these matter more than you think. The people who survived Argentina with the least damage had strong networks, friends and family who shared resources, communities that organized and helped each other. The people who were most damaged were those who were isolated. They couldn't access information, couldn't access resources, couldn't find support. A reasonable approach: get to know your neighbors. Build relationships with people who have skills complementary to yours. Join local groups. Participate in community events. Not because you're paranoid, but because human connection is valuable in all times, not just crises. Specifically, know who grows food, who fixes things, who has medical knowledge, who has construction skills. These people become valuable when the supply chain gets disrupted. Option 5. Educate yourself and your family. The fifth option is ongoing. Keep learning. Keep educating yourself and your family about economic reality. People who survived previous crises were usually the ones who understood what was happening. They saw the signals. They understood the mechanisms. They could make informed decisions instead of reactive decisions. People who didn't understand, who just assumed things would be fine, they got blindsided. A reasonable approach: read. Learn about economic history. Understand how financial systems work. Understand how crises develop. Not to become paranoid, but to be informed. An informed person makes better decisions than an uninformed person. Teach your kids. If you have children, help them understand how money works, how debt works, how incentives work. Don't make them paranoid, but make them informed. Now, here's the thing about all these options. None of them require you to panic. None of them require you to abandon modern life. None of them require you to become a full-time prepper. They're just reasonable precautions. They're just being smart about risk. They're the kinds of things wealthy people do routinely. Diversify assets, reduce debt, build income streams, maintain relationships, stay educated. The difference is that wealthy people do these things almost unconsciously. It's just how they manage money. For most people, these things feel extreme or paranoid, but they're not. They're just prudent. What not to do. Let me also tell you what not to do. Because panic decisions are worse than no decisions. Do not sell all your investments in a panic. The stock market will recover eventually. If you sell everything at the bottom, you lock in losses. The better approach is gradual rebalancing. Move some assets out of stocks into more stable assets over time. Do not move all your money to cash and hide it. Cash is only valuable if the currency maintains value. If there's significant inflation, cash loses purchasing power. And historically, governments often impose controls on cash during crises. You can't just withdraw unlimited amounts from banks. Do not make risky bets trying to profit from the crisis. Even professional traders struggle with this. If you don't have experience, you'll probably just lose money faster than the average person. Do not abandon the system entirely. The system has problems, sure, but it's still where most value exists. Most jobs are paid in dollars. Most savings are in banks and investments. Completely opting out is impractical and probably counterproductive. Do not tell everyone you know that collapse is coming. Some people will listen. Some people will think you're crazy. Spreading panic doesn't help anyone. Just prepare quietly. The real point. Here's the real point underneath everything I'm saying. If you do nothing, you're betting that everything continues exactly as it is. You're betting that $36 trillion in debt doesn't matter. You're betting that the math doesn't apply. You're betting that this time is different. That's a bet. It might pay off, but it's still a bet. If you take reasonable precautions, diversify savings, reduce debt, build skills, maintain relationships, stay educated, you're not betting. You're hedging. You're saying, I hope nothing happens, but if something does, I'm protected. The cost of those precautions is not high. Some time, some effort, maybe some opportunity cost from not being 100% in risky assets. The benefit, if nothing happens, is minimal. You have diverse savings and less debt and more skills. That's fine, but it's not a big benefit. But the benefit if something does happen is enormous. The difference between being prepared and being unprepared can be the difference between maintaining your standard of living and losing decades of savings. That's not paranoia. That's just math. That's just expected value. If you assign even a 20% probability to a crisis in the next 2 years, the expected value of being prepared is strongly positive. And based on the signals we've talked about, based on the history we've examined, based on the mathematics we've reviewed, I'd say the probability is higher than 20%. Where we go from here. Now, you've watched 3 videos in a series. You understand the history, you understand the mathematics, you understand the signals, you understand what to do about it, but there's more to understand, because the collapse pattern isn't the whole story. Some empires did break the pattern. One empire specifically escaped the trap that kills empires. How? That's the question we're going to answer in the next video. We're going to look at an empire that made different choices, an empire that understood the pattern and chose a different path. And that empire, and how it broke the cycle, might tell us something important about what's possible. The next video is called Why Every Empire Falls the Same Way and One Didn't. It's about the empire that escaped. It's about what choices it made. And it's about what that means for us. Because the point of studying patterns isn't just to predict collapse. It's to understand what alternatives exist, what choices lead to different outcomes. If you watch this series because you think collapse is inevitable and there's nothing to do about it, you're missing the point. The point is that nothing is inevitable if people understand the pattern and make different choices. Watch the next video. See what one empire did differently. See what choices it made that broke the pattern. And then ask yourself, what choices are we making? Are we on the same path as every other empire that collapsed? Or are we making different choices? The answer to that question will determine what 2026 actually looks like. Subscribe so you don't miss it.